welcome to another part of Trading Essentials here from France Fractal Trading. The stuff that I always talk about in my weekly recaps is risk management, and risk management is much more important than the methodology that you employ. Learning about a methodology, in our case, the trend following methodology, trading breakouts, following price, stopping out when the market tells us to stop out. That's something that everybody can learn. You just need to go online, look for some proven methods, backtest them yourself, trade them, get comfortable with them, and you can make money. However, that's only probably 10% of the equation. Another huge part of the equation, not the last one, but one very important part, is risk management. And when you trade, you definitely want to pay attention to risk management in financial markets. Let's take a look at what you have to pay attention to, and we are going to take a little bit of a walk through an introduction, what you are motivated by, what you can control, what you cannot control, one of the most important aspects of the whole risk management presentation here. And we are also going to take an exact look at how you should manage your risk. So let's get a start here. Why are we even in the markets as retail traders? Now, most of the time, probably 99.9% of the time, we are in the business to make money. We hear so many stories of riches. We turn on CNBC or Bloomberg and we see how thrilling and exciting trading is. I mean, you see people in Lamborghinis with hot babes right next to them, and you get your idea that this is trading. Of course, that's total BS. Now, making tons of money in an environment in which you are your own boss, you trade from your home and you're creating your own success. That, of course, is desirable for many. And in the end, maybe you are imagining driving that hot car or owning that crazy house, whatever. We all have many material dreams, why we trade, why we want to make these profits. And so let's get on now and get rich, right? So we can make it all overnight. Is that the truth? The focus in the media, the focus in social media, and for many, many people who get initially into trading is the money, the outcome of our trade and our activity. This is very problematic though, since nobody can control how much profits one makes. That's because any market behavior is beyond anybody's control. You cannot force the market to do anything, not even when you have a truly large trading account. Globalization and millions of market participants trading 24 hours, 5 days a week, make influencing the market for an individual absolutely impossible. We can always choose in our lives on focusing on aspects that we can control and focus that we cannot control. Now, by our upbringing and what school told us and how we live in Western society, somehow when we enter trading, we focus on the things that we cannot control, and that is how much money we make, what the outcome of our trades and our trading activity will be, when we finally are wealthy and make all that money and focus on all the stuff that we just motivated us to even get into trading. But of course, if you really think about it, you cannot control how much money you make in the market and what the outcome of your trade will be. So if we focus on the wrong things, we are suffering, or we are going to suffer from quite some financial and psychological consequences. And for example, I just listed some here. These are permanent disappointments because the market doesn't fulfill our expectations. We will never feel that we have met our financial goals, so in the end we judge ourselves to be a loser even though our theoretical skill and knowledge is extremely high in the trading environment. This may actually lead to changing trading size, risking too much, over trading and manipulating our rules. We are then operating from the being right or being wrong perspective, where we want to prove to ourselves and maybe to other people um, that we know what the market is going to do, even though that's not even the game that we are playing. We do not want to focus on being right or being wrong. We want to focus on trading the system, managing our rules, managing our risk, and then evolving from there and making profits from managing risk and not from, hey, I can call the market, I am right all the time. If you're into that kind of thing, then you probably have some ego issues going on and you want to prove something to other people or to yourself. You are an unbalanced trader if you do everything that we just talked about here. Your performance will be inconsistent most of the time. You will experience losses and you will experience large losses. What you end up with is a state of frustration, fear. You have a lack of confidence in the end after a couple of months, and your emotions will just completely get you down. Now, these are the things that you should not focus on. The outcome, how much you're going to make, when you will be wealthy, when you're going to buy that car. That's not what trading is about. That's what gets us into trading, and it makes us focus on the completely wrong aspects. If we want to realize our dreams, if you really want to go where we initially thought that we need to go really, really quickly, in our process of trading, we soon should focus on, or we should learn that we can only focus on the things that we actually can control. And if you limit it down to these very few things that you can control and you adapt your process to them, you will be able to actually make profits. You don't know when, you don't know how much, but you know that the market and the probabilities are completely on your side. If you trade that back-tested system and you manage that risk, you just know that over time the money will be flowing into your account because you're flowing along with the market. And that's especially true in our trend following approach, where we really only go where the price tells us to go. We're not guessing, we're not predicting, we're just going wherever the market tells us to go. So what can you focus on? What things can you control? Number one, the trading system with defined rules to enter. Where you stop is when you enter, and where you exit. Where you exit when you lose, and where you exit when you win. So these are actually four very important things that you need to have incorporated into your trading system. Where do you enter? When you enter, you need to set a stop. Where do you set that stop? And in case the trade doesn't get going, where do you get out when you lose? And number four, where do you get out when the trade goes in your direction and you win? That means that you need very specific rules, a very concise kind of plan where you apply everything that you have defined before you even enter the trade. So before you enter the trade, you already know where you do everything. And depending on your time frame, if you trade a 1 hour chart, your time frame of acting is probably like 1 or 3 days. If you trade a 4 hour chart, your time frame of acting is probably in the 1 to 4 or 5 weeks kind of area. If you trade longer than that on the weekly, your acting time frame is spanned out over a couple of weeks to up to almost a year. So you really got to know when your system tells you what to do, and it's only then that you act. And that is the other component, the psychology. We have now just discussed the strategy. The other component of the pyramid here is psychology, and that actually makes for 60%. Knowing all of that stuff, having acquired all of this knowledge because for years and years and years you put in the work, you take the time, you have aspects in your life where you do not live to the fullest because you really want to get trading to go, your psychology will remain until your last day on earth. The most important thing that is one of the aspects that you can control, but that will always be very vague, very wishy-washy. So that means you always got to be the observer of yourself while you are trading. And that's kind of the prerequisite to apply your trading system, enter, stop, exit when losing, and exit when winning most perfectly, even though you will probably never be perfect in whatever you do, because we are human and we cannot be perfect in an environment where all the information that is coming in is completely uncertain, and we do not know what will be the effect of the new incoming information. So we can always only position ourselves with a limited amount of risk and take the opportunity that the market gives us and try to profit from it. But in case we are wrong, we always have rules to get out. In case we are right, we also have rules to get out. And in the beginning, we have rules to get in. And to apply that and to control that in the most perfect way, even though we will never be perfect at it, is the trading psychology. And there will be another video on trading psychology in the coming months, hopefully. Now, getting back to where we are focusing on, 10% of your trading success lies in the trading strategy. 60% lies in the psychology, and we are talking about risk management, and that would be the third component. So you have these three components that you could split up, and if you wanted to picture it in a kind of graphic way, you would draw up this pyramid, and you would see that the base of everything is the psychology, applying it just like you are supposed to, but as a human you will find many stones in your way that you have to overcome. Next very important aspect, the second most important aspect, is risk management. You can be the most intelligent guy, you can have the best system in the world. Without psychology and risk management, you're probably not gonna make it. And since strategies are available for free online, you can read books, you can buy books, you can do a course. If you want to pay a lot of money, just go ahead and do it if you want to. Your strategy will only be important for 10% of your success, because it's not hard to profit from some sort of price movement in the market. May it be a trend, may it be in a reversion kind of mean reversion kind of system, a shorter type of market move. But it's not hard to find levels, to find signals, to find a strategy that captures some sort of edge in the market to profit. So that's why it's only 10% of the equation, even though it is very important, of course. You need to backtest it, you need to know it works. So that is important, but it's not the most important. Now, to show you how important risk management is and what we've learned already so far, I have provided two examples right there. Let me quote uh, Pierce Financial here. Risk management is a very important part of trading. As a matter of fact, it can be argued that risk management is even more important than the actual investing trading system that you use. In Jack Schwager's classic Market Wizards book series, several top traders, money managers were interviewed. These are the guys who have produced stellar returns and consistent track records over the long haul. They are the creme de la creme of the investing trading universe. What is interesting is that the methods that these different investors, traders, use can vary quite a bit from one trader to another. Some traders use fundamental analysis exclusively, some use technical analysis exclusively, and still others use some sort of mix of both. Some trade long only, others go long or short. Some trade many markets, others focus on a selected few or even only one market. There's also a wide array of different time horizons that they invest in. Some of the market wizards are short-term swing traders, while others will buy and hold for years. However, there's one thing that they all have in common: a rigorous, strictly followed risk management plan. Legendary commodity trader Richard Dennis, known best for the famous turtles experiment, said, "Discipline and risk size, those are the things that if you talk about when do I get in and when do I get out, you don't see, but it is what makes what we taught fairly consistent. Risk management is what allows an investor trader to survive long enough until they finally happen upon the opportunities that they generate profits. To be successful in the markets, you have to do three things. You have to have three things: an investment trading method with a positive mathematical expectancy, a proper risk management plan that will allow you to capitalize on market opportunities when you are right and minimize the damage to your portfolio or trading account when you are wrong, and the discipline to faithfully follow the trading and risk management plan. That's example number one from a white paper of Pierce Financial, kind of proving where we have arrived in the hedge fund world. How do they trade? What do they think about when they put on trades? The next example is a very interesting one done by Tom Basso. He explains about the coin flip experiment. Now, he is a former hedge fund manager and now a proprietary trader, and he once conducted an experiment where he took trades based on a coin flip. The rules of his system were pretty simple. Enter the market long when heads come up, enter the market short when tails come up. Place an ATR average true range stop and never risk more than 2% on any trade. So, let's sum this up. Basically, he says for his trading method, he has two rules. He goes long when he flips the coin and heads come up, number one. Number two, he shorts the market when tails come up. That's his method. Very, very easy. Now, to get kind of a risk management, money management control into that, he has a third rule where he says we are using the ATR indicator and we never risk more than 2% on any trade. So he is having a plan in regard to his methodology. He's having a plan in regard to a risk that he puts on. Now, his psychology needs to be controlled, of course, but that's something very individual, and we really cannot look into that anymore here at that point. Now, the outcome of the coin flip experiments is that he was trading 10 markets over 3 years, quite a long time, 10 markets, 3 years, and his overall performance was positive. Now, he did nothing more than flip a coin. Now, you would expect that maybe you need a very complicated trading system and you have to do a lot of math, and I don't even know what you want to do to come up with that great idea, that holy grail kind of idea to beat the market. But you just need a coin flip to have a overall positive performance. Now, he made money using the coin flip principle as his trading system. That's crazy. And it also shows that it's not your trading system that decides on how much money you will make, but it's your risk management and your psychological well-being to execute your entire trading approach perfectly. Of course, you still need a thorough back-tested trading system. So don't underestimate that, but still trading system only makes 10% of the importance there. Let's take a look at a couple of scenarios in regard to risk management. What we will do is we will compare two systems, trading strategy A, trading strategy B. In trading strategy A, we have a strategy that probably a lot of people are looking for. Now, when you go through the social media, what you see is people always want to have a high win rate. So here in trading strategy A, we have a 90% winners rate. We are applying no risk management at all, and therefore we have extremely variable position sizes. We take 10 trades and we are taking a look at the profit. As we have no risk management, our trades can really have any outcome. Depending on where we decide where we should exit, we may have very high wins, but we also may have very high losses. So on 10 trades, we are assuming that we gain 10 points or 10 ticks, 9 ticks on 9 trades, 10 ticks on 9 trades. I'm really sorry here. We have 9 trades, we have 10 ticks that we gain on each trade, which makes for 90 ticks, or pips, and whatever you trade, that kind of name is different. And on the 10th trade, since we have no risk management, we lose 98 ticks. That ends up at -8 at the result. So we have a 90% winners rate, but the last trade, because of no risk management, loses us so much that we are ending up our 10 trade kind of test streak with -8. In trading strategy B, we have quite a different scenario. We only have a 40% winners rate compared to the 90% winners in the negative kind of outcome strategy A. We now have 40% winners. We manage our risk. We only risk 2% per trade, and our average win is 2 times the average loss. That's what the backtest tells us about trading strategy B. So what we end up with is 4 trades with a 10 tick gain, and then we have 6 trades with a 5 tick loss. So number one, what we notice is we have less trades winning. We have only 40% winners, 60% losers, and we have a gain of 10 points in every winner and only a 5 tick loss in every loser. So we have 40% winners at 10 ticks per winner, and we have 60% losers at 5 ticks a loser. That ends up at plus 10 ticks, right? And here we have -8 ticks. So trading strategy B is a trading strategy that you would find in a trend following system. You have less than 50% of winners, but your trading strategy overall will perform positively. Uh, Over here at the 90% winners, you will probably find some sort of scalping or mean reversion, or I don't even know what strategy. Not managing your risk is deadly, even though you have a 90% winners rate, because it takes only one trade to kill all of your gains. And it's very, very hurtful emotionally to have a 9 streak winner kind of time cycle and then lose everything on one trade. Now that again has some implications for your trading psychology, and that's very important to focus on. That all the aspects of trading that we mentioned, psychology, risk management, strategy, they are interconnected. If you make a mistake in your risk management, it will immediately cause you to have psychological effects, negative effects, and that will then cause you to manipulate your strategy. Even though you backtested it and you know that your overall performance should be positive, it is absolutely possible in an emotional state that you may not have expected or that may be unbalanced to screw up in the risk management kind of place to have an effect on the psychological part and then manipulate your trading rules, which then definitely will end up in losses. So you need to straighten out all of the 3 parts. You cannot leave out even one of them. If one of them doesn't work, you're going to fail. All in all, from this kind of slide here, we learn that when choosing a trading strategy, it is less important how much of the time that the strategy wins. It is much more important to focus on the factors such as average win versus average losses, risk-reward ratios, average monthly and yearly performance, maximal drawdown, to seriously judge whether it is profitable or not. A thorough backtest is absolutely necessary before you go live. Now, that's of course um, self-explanatory. Most of the professional trading platforms will offer you a bunch of performance analysis statistics, and you will find all of the things that I just covered and even more. You should definitely have a view and an outlook on what you're doing and how you are performing, how the past month, year, and last 5 years were in your performance. You need to absolutely treat this as a business. This is not just a hobby. You need these statistics. You need to keep track on this. You need to know what you are doing. If you use no risk management and you only apply your gut feel, maybe not even a system, If you have that, and you think that you can always be right, then you are completely wrong. Not even star investor like Warren Buffett is always right. So there were 50% drawdowns, three of them throughout his career. So make sure you understand that without a very defined trading system and very defined risk management rules, you have no chance of survival in this place. You will not do it on hype. You will not do it on CNBC or whatever Bloomberg tips. Don't follow any market guru. Know what you're doing. Create your own kind of approach. Learn from other people. Know who is successful and who has to offer something worthy, and then apply it to your own stuff. You will never ever be 100% right. Take your system, take your risk management, take your trading psychology to the next level and know what you're doing. Have this long time goal where you apply all of this stuff. Okay, don't trust your gut system, your gut feel. Don't trade without a system. Okay, you know that losses will occur. There is no way around this fact, and especially in trend following, there's no way around this fact. And you have to learn to accept it as part of this game. You know, it's like poker and trading very much. You know that you will have losses. It takes these losses to make money. It just takes it. You got to get in that game. You got to feel, is this market right? Is it moving? If it's not moving, you get out with a small loss. If it is moving, you stay in, you add on to your position. So to reduce your psychological and emotional fluctuations, called the roller coaster effect, position size needs to be adequate, or how else are you going to cope with the following scenarios? Okay, remember, we are looking at how do we get in the market into this place that is completely uncertain. Nobody knows what happens tomorrow. How can we make money in a place like that where nobody knows what's going to happen? Then predictions, they do not work. How do we get on with that? And we can do it simply by controlling our risk and making sure we are applying our trading rules perfectly. Let's assume the following scenario. We have a $25,000 account and we are not applying risk management. Let's assume we have a strategy that is in a drawdown, meaning it doesn't work very well at the moment. Please remember that there is no strategy that works all the time. If you trade trends, if you trade mean reversion, a mean reversion trader will lose when the market is trending. A trend trading trader will lose when the market is going sideways. There is no strategy that wins all the time. Therefore, make sure you have this risk management going on, because if not, you're caught up in this phase where the market is not going your way. This here might happen. You have a couple of losses in a row. Let's assume you have three losses in a row on a $25,000 account. Now, since you're not controlling your risk, you have three losses in a row, losing 8%, 4%, 9%. Altogether, that makes for almost 20%. That's losing you $5,000 almost on your $25,000 account. That's absolutely unacceptable. Five losses in a row will kill it even more. You are maybe at 5% in the negative, 10%, 3, 7, 11%. You're losing a 30% of your account. That's that's crazy. You only have about $17,000 left after you dropped five losses in a row on a $25,000 account. Seven losses in a row, the table explains itself. You're in the negative for 41%. You only have $14,680 left. That's absolutely unacceptable. And 10 losses in a row in an environment where everything is uncertain are absolutely possible. You might be caught up in an environment where you trade many markets, you don't know what's going on because you use a totally technical approach. And by the way, I don't think that fundamentals would clear the problem, but you don't know what's going on and you just put in your orders according to your system. But since the market is maybe correcting, if you are a trend trader, you get stopped out in everything. And five losses in a row, that's no problem. That happens all the time in trend following. Okay, So make sure you control your loss. Let's take a look now at an example where we are controlling our loss. Now, you definitely have to have in your trading arsenal these performance analytics where you look at your performance, average win, average loss, yearly performance, monthly performance, and so on and so forth. You also need to have a risk management Excel file or wherever where you can write down the exact entry price, stop price, lot size, what's the conversion into your currency, what you will lose in accordance to your current account size. So let's take an example trade where we calculate the risk. We are looking at October 23rd in 2014 Euro US dollar short trade. Let's assume we have a $100,000 account and we're trading 50,000 lots on a daily chart. We have the chart right down here, and we have the fractal here. This is now, of course, according to the trend following approach that I use. We have a fractal cell right here, and that is a price of 126.10, and our stop is in the balance zone at that fractal created right there at the red line here at 127.8. So that makes a short position with a 168 pip risk. The 168 pips is not what we care about. It doesn't matter if that's a high number or a low number. What we care about is how much is this pip amount in relation to the account that we have. What kind of lots can we take to never risk more than 1% on an initial trade? Now, risk management really depends on your personal liking. You hear people that say you should never take more than 2% risk on any initial trade. Some people only take a 0.5% on an initial trade. In my personal favor, I never take more than 1%. Usually I end up taking 0.7, 0.8% of risk at the initial entry. Remember, we are trading a trend following approach. We do not have 50% of winners. We only have 35, 40% of winners every year. That means on every loser, 60% of the time, we want to make sure that we do not lose too much. When we enter a trade, it loses, it's no problem because we do not have a lot of risk. 0.7, 0.8%. If we have a winner going on, we let the 0.7, 0.8% winner going and we add on to our position. That's not the topic of today, but just to make the whole concept clearer, we do not lose a lot when we lose, but we make a lot when we win. And that's what we see here. When we finish the calculation, we want to aim at a 0.7, 0.8% risk. Here we calculate a 0.84% risk when we lose 804 euros on a $100,000 account if we take a 50,000 lot position. You can, of course, and this is the main part, manipulate your lot size to come or to achieve the profit and loss percentage suitable for you. Remember though that there is a limit to that. On this slide, we are taking a look at what do you have to gain if you lose too much. Not taking risk management into account, not calculating like we just saw, you may actually end up at quite some issues. If you take a 10% initial trade entry position because you think, oh, the market looks so good, this chart is awesome, let's short it, let's go long, whatever. You got to make sure that you understand if you lose, you got to make back more than you lost. If you lose 10% to break even, you got to make 11%. If you lose 20%, you already got to make 25%. Now, the clearest point is actually here at the 50%. If you lose 50% of your account, you have a $20,000 account, you lose 10,000 euros. In order to break even, you have to make 100% on your 10,000 euros to come back to 20,000 euros, which is your initial balance. So let's say you achieve that, you can pat yourself on the shoulder that you just made 100% on your equity, but you also got to realize you just broke even again. So make sure you understand these kind of mechanisms that are going on with position sizing. If you are too big in your position size, you are going to fail. You need to make sure that by your trading system you have a very definite entry that gives you an exact price. And you also have a very definite stop by your trading system that gives you an exact point where you would exit if you lose. The distance between your entry to your stop must never exceed, counted in dollars or in euros, the 1% or the 0.7 or 0.8%, like in my case, or the 0.5% in other people's cases. Amount of your account, otherwise you will fail. Okay, that's very important because you got to understand you're not going to gain 25, 43, 100% a lot of the time. The market has to be awesome for you to gain that. So if you make a little mistake, you make one false trade where you do have your entry and you do have your stop, but you're risking 50% or you're risking 20% or you're risking 70%. You need to make back so much percentage-wise that it's very unlikely by a controlled risk management technique that you will make it back anytime soon. And that will be a long and a very painful drawdown phase. There are some basic principles regarding risk management. Not only the numbers are important, but you should also diversify your trading activity into different asset classes, stocks, commodities, currencies, bonds. You should measure the volatility in your account. So, for example, your performance statistics in your professional trading station should give you a Sharpe ratio or Sortino ratio. You got to be aware though, low volatility doesn't always have to mean that you are well diversified in your account. It can simply mean you are taking on not enough risk. Okay, so by controlling your risk, you always know how much exposure your account has. Do you even have the chance, if a trend is unfolding, to make back all your losses and to gain a little bit more? Or have you become so conservative that you're not risking enough? If you only risk 0.1% or even lower than that amount, you're probably not risking enough. Diversifying here in this regard only means, and that's what the Sharpe ratio and Sortino ratio show you, that you need to be invested in different asset classes to not have your risk all in the euro, all in the indices, all in the metals. You need to diversify in that regard, but you also need to control your risk management percentage-wise to make sure that you're taking on enough risk and not too low. What I already mentioned is the need for a measure to have an idea about your absolute account exposure. We've now been talking about the individual trade risks, but your total account exposure also needs a definition of how much it can be exposed. So you need to differentiate between the absolute risk in your account and the risk on each individual trade. You always have to trade with a stop loss. No stop loss means the inability to calculate risk and risk reward ratios on a trade. Trading is about managing risk. You can't do that if you don't measure your risk, okay? If you have no idea how much risk you got on in the first place, you cannot manage it in the end as well. You cannot manage it as the trade is going on. Any good trading system will provide you with very clear rules where to set your stop loss and therefore having the ability to calculate your risk. Also pay attention to margin requirements if you trade futures or CFDs, especially as they are changing from initial to maintenance and overnight margins. In trading and measuring your risks, there are no complicated mathematics involved. It's just common sense that can manage your risk well enough, okay? You are really playing the numbers game in trading. The distribution of wins and losses in any given set of trades is completely random and it cannot be predetermined. Therefore, clear risk management rules are necessary to be able to keep on trading. Remember, you can only trade if you have capital. Therefore, when losses occur, the task of capital preservation is most important. It's very essential to distinguish between your absolute account risk and your individual trade risk. We already talked about it. Never risk more than 1% on your initial entry. Probably you should even risk less. You have to really get into that by yourself and find out what your individual style is, okay? Now, let's take a look at the total account exposure. This is also very individual. Just as a kind of rule of thumb, maybe, you can take 25% on a on one account that you are trading. So let's say you have 5 trades, 10 trades, 15 trades open. They should not exceed more than 25% of your total account value. So each trade, 0.5, 0.5, 0.7, 0.7, 0.8, maybe 1% of risk. Altogether, never more than 25%. You don't know what's going to happen tomorrow. If you have a 100% account exposure and everything starts to go against you, which you don't know if it will, you will be done. You will be out. You will not have survived. You will need to add more money to your account, and that will be very frustrating because you will be starting from scratch at that point. Over here, I just noted some other numbers that may have importance to you in regard to your own risk management. When we focus on risk management, we are really focusing on the power of compounding. Only taking small percentages of risk will, of course, not make us 1 million bucks in a year, like we said at the beginning. It will be much more difficult. Please realize that every profitable trader uses the aforementioned risk management rules in different variations. As I said, it's very individual. Therefore, none of these elite traders or investors really ever have big jumps or big losses in their accounts. They go for the compounding effect, okay? Let's take a look at the compounding shown here in this graph. We have many years going by here on the x-axis, but as you can see, the exponential curve that turns up shows us what happens if you have an account and you grow your money with risk management, booking wins again and again and again by applying your system again and again and again. That's all that it is. There's no thinking about it. There's no overcomplicating it. There is just this exponential curve that is the effect if you just compound your returns. Now here in the table on the left side, we have a overview of how much percent you can make, or if you made this kind of percentage in a year on a $10,000 initial investment where you grow over a period of 40 years. Okay, so 40 years is a pretty long time. $10,000 is not a lot. Let's say we are growing at 10% a year. After 15 years, we would have taken $10,000 to $41,000. So we would have more than 4 times the amount that we had 15 years ago. That's not that bad. 4 times the amount if you imagine you have a larger account. Maybe you got some years in there that your trading strategy performs better than 10%. You can really take your account to places that you have only dreamt of, okay? Coming closer to the end of talking about risk management, we have some important notes that if you have an ego too big and you misjudge your risk appetite, then you could suffer some disastrous results. For any trader that's taking on too much of risk, emotional responses will be triggered and they will be negative, even when it's a winning trade. When you win and you have too much risk going on, your emotional response will be out of balance so much what you perceive as positive, but it will actually be negative for you because you are very likely to risk too much again because you have the proof that it worked the first time, and the second time though it will be a loser, and your equity curve, your performance curve will be very bouncy. It will be very unstable, and that's what you do not want. Therefore, judging your risk management and being able to observe yourself and know for yourself what you can take, how much is good for an individual risk per trade, how much can you take for total account exposure, is very important. Okay, so unbalanced emotional states lead to unbalanced states of mind, which cloud your ability of judgment and perfect strategy executions. Euphoria, greed, false sense of ego are all examples of that. A negative trade outcome with too much risk leads to fear, to not being able to pull the trigger, changing your systems, changing your system parameters, overtrading, taking too much risk, and so on and so forth. There is an interconnection of risk management factors and their influence on the trader's psychology and the emotional state by whatever the trading outcome may be, is the essential part of trading and should be the main focus throughout any serious trader's career. Here you have two equity curves of systems being applied most perfectly, of course, where we can see how the performance looks after, here on the left side, of 377 trades, managing risk. That's 10 markets traded over 10 years, one contract per signal. Managing risk, here we have the Abraham Salem fund, hedge fund performance compared to the S&P and compared to the Altegris kind of measured funds, where you can see, started in 1990 to 2015, the performance if you trend follow, if you manage your risk. Okay, that's very important. You will not survive without that kind of stuff. To finish off the presentation for the day, here we have some more examples regarding managing risk and not managing risk. Again, you have seen these tables. In the very big one, we see the outcomes of losses, various amounts of losses in a row if we manage our risk. Down here, the table that you already saw with the -19, -31, and -41% loss, not risking, not managing risk, taking 3 losses, 5 losses, 7 losses in a row. What happens if you do manage your risk? With 3 losses in a row, you only lose -5.8%, 2% loss per trade. Down here, 19.6% loss. So you have a loss 4 times as big, almost 4 times as big, without risk management than if you manage your risks. 5 losses in a row end up at -9.6% compared to -31.4%, 3 times as much down here, and 7 losses in a row end up at -13.2% compared to the -41% down here. Okay? Over here again, the kind of overview of what you have to gain if you lose too much. This is the most important number. If you lose half of your account, you need to double your account to come back to break even. And that's just so devastating. Hopefully you learned something today. Comment on the video, like the video if you really liked it, and I see you soon, hopefully.